To recap our first video on the subject, macroeconomics evolved out of the Great Depression of the 1930s, which taught market economies a bitter lesson. They didn't automatically adjust to bad times, didn't automatically emerge from the downturns of a cyclical economy in the short run. That is, they didn't necessarily adjust quickly enough to avoid widespread, fairly long-lasting economic misery. The message of the first video was that government sometimes has to get involved to jumpstart things using fiscal policy. So when GDP, that is, the economy, begins to contract, the government starts spending more and/or taxing less to get the economy up and growing once again. This video, though, focuses on a second form of government macroeconomic activism, monetary policy, as practiced by the Federal Reserve Bank. And here's the key picture, the supply and demand model of the economy as a whole that you've seen before, depicting aggregate supply and aggregate demand. On the vertical axis, we have the price level of the economy as a whole, the average price of everything, weighted by how much of it is sold. On the horizontal axis is the total quantity of everything the economy produces, real domestic output, the GDP. Our story begins back in the 1960s.
Here she is. She is single and fun-loving.
This is more or less what the 60s looked like on television. This is closer to what it looked like to those of us in the video business, as best we can remember anyway. And here I am in the days of hair. But economists, thankfully, were looking at some very different pictures. Then President Lyndon Johnson had begun spending more and more government money in order to fight two wars. First was the war on poverty, to create what he called a great society. The second war was in Vietnam, to keep communism from spreading throughout Southeast Asia. Andrew Brimmer was appointed to the Federal Reserve Bank Board by the president.
As Johnson began to increase expenditures, it became evident that this is going to lead to inflation because the economy is pretty well fully employed. There is little excess capacity.
And if the economy is already operating close to full employment and full capacity, money spent by the government isn't going to mean more work or more production, but higher prices.
Aggregate supply is limited, so prices are going to go up. That's going to be inflation.
You could see the macroeconomic results of such government spending by looking at the aggregate supply and demand model. If the economy is stagnant, GDP is low. One look at the aggregate supply curve shows that GDP can increase by a great deal without having any impact on the price level. But in the mid-60s, the economy was already humming and near its full capacity. So when President Johnson went on his government spending spree, he shifted the aggregate demand curve so far to the right that it reached the point where the aggregate supply curve turns straight up. Since past this level of GDP, the economy simply can't produce anymore, the result of an increase in demand was a general increase in prices, inflation. Which brings us to the Federal Reserve and monetary policy. What the President and Congress couldn't or wouldn't do, stop spending to put a brake on the economy, the Fed could do.
If you can't reduce the government's demand for goods and services, there must be a reduction in the demand for goods and services by the private sector. And how do you do that? You control that by increasing interest rates and making the supply of credit less. And that's what the Federal Reserve does.
And that's what the Federal Reserve did. It began raising interest rates to slow an economy getting too close to its maximum capacity and therefore beginning to experience inflation. Interest rates reached an all-time high of 6% in 1969. At that point, the Fed began worrying about a recession and started lowering rates to spur growth. But when inflation persisted, the Fed was forced to raise again. A recession forced the Fed to lower rates in the mid-70s, but inflation was spurred by the rising price of foreign oil. So the Fed again reversed course and kept raising interest rates, except for 1 year, to a dizzying 14% by 1981. The Fed finally licked inflation all right, but at the cost of another recession. So the Fed started cutting rates again to get the economy going. It cut, and the economy grew pretty steadily, all the way through 1986. At which point you can guess what happened. The fear of overheating and inflation caused the Fed to raise rates in the late 80s, lower them when the economy stalled around 1990, and raise them and keep them there once the economy began shooting back up. Only in the year 2000, when the high-tech boom collapsed and the economy sagged, did the Fed begin cutting rates once again, cutting them sharply until fears of inflation once again prompted a series of rate increases starting in June of 2004. Now, all this raising and lowering is what's called fine-tuning, as the Fed fiddles with the money supply to keep the economy in between inflation and recession. The next question, though, is how does the Fed actually affect the economy's rate of interest? As the Fed's own cartoon was designed to illustrate, our central bank increases the amount of money circulating in the economy when it wants to lower interest rates, since when there's more of something, its price tends to go down. That's all a lower interest rate is, a lower price for money, which will make people willing and able to borrow more of it. The more they borrow, the more they tend to spend, boosting economic activity. But eventually, the theory goes, this will cause prices to rise dangerously. The fear of inflation then prompts the Fed to decrease the amount of money in circulation, which raises the cost of money. Same logic as before. If there's less of something, its price goes up. A higher interest rate discourages borrowing and slows the economy back down. Now, by money supply, we don't mean the actual cash circulating in the economy. Yes, the Fed is in charge of currency, but all the bills and coins in America add up to a mere 10% or so of the nation's money supply. Most of our money, of course, is in the form of deposits, in banks, mutual funds, and the like, and changes hands via check or credit card. Currency is for the small stuff. The decision to change the overall money supply and thus speed up or slow down the economy is made behind closed doors every 6 weeks at this room in the Federal Reserve Building in Washington. It's a highly secretive affair. What we mostly see of it is the Fed chairman, from 1987 to the present, Alan Greenspan, periodically and patiently explaining the Fed's overall view to Congress, without saying what the Fed is actually going to do.
Clearly, the Federal Reserve will have to monitor carefully ongoing developments for indications of potential inflation or a strengthening in inflation expectations.
To understand the process behind such pronouncements, we assembled a mock Fed meeting of our own, featuring a few former members of the so-called Open Market Committee. It started with the usual staff report delivered here by a former Fed staffer.
Velocity of M2 and M3, the ratio of GDP to these monetary aggregates, seems to have risen. So net of all of these factors, the staff views that the GDP outlook is for about 3 to 3.25% growth.
This mini-meeting was smaller and simpler than the real thing, but the economic data were real, so was the format, and so was the main problem: whether or not to change short-term interest rates, and if so, by how much. Before we continue with the meeting, though, a technical question. How does the Fed actually control the money supply and thus interest rates? The Fed's most visible tool is the discount rate. That's the interest it charges banks for overnight loans. These loans don't really amount to much in terms of the money supply, but the discount rate is watched closely because it reveals how the Fed will wield its most powerful tool, its open market operations. If the Fed wants to lower interest rates, it goes on a sort of spending spree. Technically, it buys up IOUs of the U.S. government, like Treasury bonds or Treasury bills, from securities dealers who trade them. The money the Fed spends ultimately makes its way into the bank accounts of those who sell the bonds. So the banks suddenly have more money on deposit. That means they can charge less to lend it out, lower their interest rate. By contrast, when the Fed wants to slow down the economy, it starts selling Uncle Sam's IOUs, better known as U.S. Treasuries. In the process, it sucks money out of the banking system. With less money to lend, banks tend to charge more for it, driving interest rates up. Through these so-called open market operations, the Fed can add or subtract billions of dollars from the economy overnight. Monetary policy then is fine-tuning the economy by manipulating the money supply. And what guides the Fed on which way to take monetary policy? Forecasts of the economy's future. However,
the forecasts really aren't always that correct. You know, if you look at an econometric model, it's basically an average of past experience, and past experience doesn't always work out that way.
Nancy Teeters, a Fed governor from 1978 to 1984, was appointed by a Democratic president. But even when an economy is growing, Fed governors like Teeters worry less about a runaway economy and inflation than an economy that may not be growing fast enough, may not be providing enough jobs.
And we still have a lot of excess capacity. I mean, there's 6.5% unemployment. It's 83% increase in capacity utilization. We don't get into trouble till we're above 87.
Republican appointees like Lyle Gramley, however, who started with the Fed in the 70s, worry more about overheating and inflation.
Growing at 3.5% persistently when your long-term growth potential is 2.5% is a recipe for disaster.
Gramley's talking about the aggregate supply and demand curve. He thinks a growth rate of 3.5% means the economy's at the kink in the AS curve and ready to head straight up into inflation. At the end of the day, the Open Market Committee votes to wield the one weapon the Fed has in its arsenal, the price of money.
The proposal on the table is for an immediate 25 basis point increase in the funds rate and a consultation meeting over the telephone in about 2 or 3 weeks on the possibility of another 25.
A basis point is 1/100%, so 25 basis points is 0.25%, a 1/4 percentage point rise in interest rates.
So I go around the table. Mr. Siren?
I would vote for that.
I would also.
Bill?
I would like to see 50 basis point increase at this time.
You would dissent?
I would dissent.
Dissent.
Mr. Gramley?
Yes.
Ms. Teeters?
I would vote for it reluctantly.
And I vote yes. It's carried 4-2. Thank you very much.
But to critics like Susan Lee, the Fed's micromanagement of the macro economy is a mistake.
A little here, a little there, a little here, a little there.
Right.
And
you don't like that.
I don't think it's the job of the Fed. The job of the Fed is to give the economy stable prices. It can be stable prices. The Fed can say 2% inflation year after year or 0%, but the Fed should say one or the other.
Susan Lee's idea is an old one, especially popular with conservative economists. The Fed shouldn't spend its time trying to divine the direction of the economy. It should determine a constant fixed target for inflation and manage short-term interest rates accordingly. Going even further, economist Robert Lucas won a Nobel Prize for suggesting that the rest of us can see through what the Fed's doing when it finagles with interest rates, and that our rational expectations will frustrate the Fed's efforts to influence us by changing the price of money. But despite these critiques, the Fed continues to fine-tune the economy, as it has for decades.